Um,
Yeah.
all right, so we'll go till around 8. Somebody, I can't see. I don't have actually a clock on this when I'm in full mode. So Carl, when we get to about 8, let's take a break.
Okay.
8:05 maybe, depending on how close we are to the end of the section. All right, so let's talk about some of the forecasts that have been made. Uh, the Federal Reserve just put out their forecast last week. And as you would expect, it is considerably worse than what it was before. So the December projection on here is what they thought sort of pre-crisis. And then they delayed their first quarter one, I believe. I don't think they did not put out one for March. And then we got this June um, revised. Now, the good news is the longer run has really not changed. If you look at those numbers on the right, 1.9, 1.8, 4.1, 2.0, I mean, they're pretty much the same. So that tells me they're not thinking, severe permanent damage. Uh, they think this is something that has a lifespan. On the other hand, you did see some pretty significant changes. So the GDP in 2020 dropping 6.5% for the year. I mean, that's pretty serious. The you just remember that number is usually like 2% growth, right? So 6% loss is like erases 3 years of 3 years plus of growth at once. Um, the unemployment rate, tripling from 3.5 to close to 10. And inflation, though, not a big issue. It's really, unless you're worried about it in deflation, but moderate inflation somewhere between 0 to 2 is not going to rattle things too much. And you know what they're going to do with interest rates is maintain them pretty much at zero as long as it takes to recover. They've made that clear. So that's the Fed forecast. Um, the Congressional Budget Office did their forecast as well, and they did 2020 and 2021 also. And you can see the quarter details though here, some very large quarterly numbers annualized, meaning, for example, where you see there in the second quarter real GDP annual rate minus 37.7, that is annualized. If and so it's somewhere around, let's see, 9 times 4 would be 36. So it's not like a 9% drop in the second quarter. Annualized is 37%. Yeah, 9 times 4 would be 36, so a little higher than that, 9 point something. And then they expect things to bounce back quickly. So Trump has already started doing this, and so have his people. Praising these record increases. Record job increases, record number. You're going to see when the GDP comes out there. Probably not this quarter, but the third quarter, you're going to see record GDP growth. The thing to keep in mind is, where are we relative to the starting point? Are we back to where we began or not? Don't get hung up on these numbers. And as on the quarterly numbers of large growth number doesn't mean all is well, but it means we're going the right way. And Carl mentioned earlier that 50% decline needs 100% to bring you back to start. And so that you got to kind of discount the rebound numbers a little bit when you look at them. They're not apples to apples with the drop. So keep that in mind. And the reason is the math is you're starting from a lower base. Once the drop has happened, you've got a smaller base, and so in theory, it's easier to have a bigger percentage gain going back up. And you need it to get back to where you started. So similar other things here. They actually showing the negative inflation for certain quarters. Carl showed the chart earlier on the inflation dropping to almost zero, and you have the unemployment rate. We've talked about, you've seen those numbers going up into that 15 to 20% range, depending on how you, 13% in the latest, but somewhere in that 13 to 20% is probably the accurate figure. And then the interest rates are very low, close to zero. One of the reasons why I think the stock market has jumped is that you just don't have much in alternatives in the bond market. You can't get much yield. You can get stocks that have a 4% dividend, but you can't get a bond that's yielding 4% unless you really roll the dice on something very risky.
So looking at this chart, that third quarter economic growth of 5.1% is going to be reported literally the week before the election, because the third quarter ends September 30th. It's reported the last week of October. So we will have a positive report right before the election on GDP. At the same time, also in October, we will have a report from the September employment report of the first week of October. We'll have an unemployment rate well up into double digits, according to this. Also in October, we'll report the fiscal year 2020 budget deficit for the year ended September 30th of around $4 trillion. Huge increase versus prior years. So it'll be a mix of numbers that Trump has to try and sell as real positive.
The giant swoosh here, as they call this, is the Congressional Budget Office projection, is that we won't get back to where we started in 2021. We'll still be struggling through 2020 and 2021 to get back. And so sometime in 2022, you would get back to the starting point. So keep that swoosh in mind. Every time Trump says, I got 20% growth this quarter annualized, you could say, yeah, well, you're still 10% or 6% down from where you started. You'll have that. It's that kind of thinking. That's the sort of quick counter to something like that. And so Carl and I will equip you with swooshes as necessary. Let us know. We'll have it in our presentation of we'll graph the actual here as we get data. Congressional Budget Office also did a comparison over 10 years. And what they're doing here is saying how long before we get back to the forecast that we had. So not back to where we were at the end of 2019, but how fast does it take to get back to the forecast we had before this crisis happened, which would be that January baseline that they had, I believe. Yeah. And so they're actually saying it's going to take 10 or 11 years to catch up, to an alternate universe where we didn't ever have this crisis. So if you can imagine GDP growing steadily at 2% for 10 or 11 years, and this swoosh kind of trying to catch up to it, it's out there at year 10 or 11 where we catch up to that upward going line. So it's a little hard to kind of interpret it here because you've got this flat line at the beginning, but think of it as a 2% growing line, and it takes 11 years to catch up to that line. That's what they're saying. So it's going to be a while. And that you would expect that. I mean, as you think about, if I go back to the swoosh here, I mean, it's going to take a long time to get back to that pre-crisis, trajectory. And then you're still going to be lagging. You're going to be chasing it for a long time. And so this sort of assumes that this other chart sort of assumes that things will pick up sort of in those out years to get back to that 2% line. If you fall well below it, how do you get back there? Well, you got to do better than 2% to catch up. And they think it's going to take a long time. They have a forecast for number of unemployed. And so Carl and I shared the actual with you, but this is their projection by quarter of how many will be out of work. And they've got unemployed, but they're also showing you how many went outside the labor force, how many more went out, and they're giving you a number based on that. This is millions of people, not a rate. So it just so happens that the number of unemployed, which is about 21 million as of the last month, is probably in the ballpark of what the sort of most accurate estimate of unemployment probably would be at this point. But it just so happens that it's 20 million-ish unemployed as they define it. And here is the CBO showing you also with the labor force, people that have left, a few million more on top of that. And just to give you a sense of, what's the swoosh look like, the New York Times interviewed 500 plus, they interviewed 500, but not every line item here has a sample that size, and you'll see that. But hundreds of epidemiologists were asked when you would expect to resume certain activities. And the left side are the ones they would get back to sooner. The right side are the ones they don't expect to get back to anytime soon at all. And you can see the distribution of how many think in different ways. And this was done in the beginning of June. So the survey, if this was reported on June 9th, the survey was probably end of May or the first part of June. I think you'll probably see some in here where you realize, geez, I didn't think about that. Like, I just go get my mail. I just go get it, bring it in. I don't. I mean, we have all kinds of CDC quarantine measures where we put on our gloves, we go get the mail every couple days at a time before the mailman comes. So the mail's been sitting for at least 24 hours. I mean, that kind of stuff is what we do now. 2/3 of them are saying, they may get over that at some point this summer. But 3 to 12 months or a year plus are still sizable. When you see some of the things I highlighted, going back to school is one of those incredibly disruptive ones, because if the kids are home, at least one parent has to be home. And that could be a serious problem for parents that have to actually go out into the world and work, as opposed to some of us that can just work from home. It's a really big deal. So there's some interdependencies on some of these items. Any of these surprise you as you look at these? Anybody have a you know have a much different view than this? Would you say? No. Okay.
I mean,
Oh, go ahead.
I went to in-person doctor's visits this past week and have started, and we'll have, more next week. So I'm, leading on that first category.
Yeah. Yep.
But
Okay.
before I do my colonoscopy on Monday, it's a
Ay, ay, ay.
mandatory COVID-19 test on
Uh-huh.
Friday.
Yep. Yep.
Because
I,
they want to make sure all of us are not carrying the virus
wow.
before we do the more risky procedure.
Wow. Good for you. Good for them. All right. This is kind of an interesting data set I'm starting to see a lot out there. The U.S. mobility data is requests for directions. That's in the upper left-hand corner. How many people are asking for directions, whether they're driving, walking, and I'm not sure what transit is. Maybe direction requests for information about airlines or something, or maybe probably trains and buses would make more sense. Probably is what that is for help where they're going. Um, so you can see that big drop off, and it's starting to come back. Has come back quite a bit in terms of driving and walking, but not so much yet for transit. Using public transportation, I guess, is how to interpret that. But airlines are still way down, 80, 90%. Hotel occupancy is still down significantly. It's around 35% as opposed to 70-ish where it normally would be. And then the dining is still pretty far down too. It was almost gone. You can see it was down almost 100% for a while during the April lockdown period. The restaurants were closed, so nobody was going. But they call these the high frequency indicators. They're trying to get read on how fast things are turning around based on some of these data sets that you can get daily or however frequently the different groups are publishing this stuff. And I always I always mention Wells Fargo. They just did their mid-year economic forecast. It's free. If you go to Wells Fargo Economics, you can sign up for a weekly newsletter. They send out like a 3 or 4 pager every Friday. They don't give you other advertising. I've never seen anything that's coming from them as far as I know. And it's just, and their site has a ton of economic reports on about every subject you can imagine, and they're all free. So this was taken from their mid-year review, and I recommend their stuff. At least it's good briefing on, kind of what Carl and I do.